Hello again, and welcome to Clear Skies Retirement with Jay Kirkwood at Secure Financial Management Online. As always, retire210.com. We're glad you found us here today. This is a show where we talk a little bit about that time in your life where you're going to hang up your cleats. You're going to get out of the cubicle. You're going to put up the hard hat. You're going to walk out of the classroom, walk out of the courtrum, whatever it is that you do, somewhere along the line.
Whatever room it is that you work in.
That's it. Yep. You are going to be out there, and the paycheck's coming from you now. How does that work? That's what Jay does, and that's why we have this show. Jay, how are you doing today?
Doing good, Randy. How have you been, bud?
I'm good. A little up and down in this market business here. I mean, we've got a lot going on, don't we?
No kidding.
We really do. And
yeah, we sure do. And that's the nature of the beast.
Yeah.
Right. And, I talk to a lot of people about this sort of stuff, and the whole point of the discussion is that you shouldn't be invested in the markets if you can't handle these ups and downs, because it is going to happen, right? Every time we're onboarding a client, we talk about the risk, and I was like, hey, look, there is going to be some downtimes. Like, let's not kid ourselves.
Yep.
And the important thing is having a plan to deal with those times that you know are going to happen.
And not walk in the halls at night saying, oh my gosh, I just lost 3% or 4% or 5%, and now we can't go on that trip that we thought we were going to go on. That's not what you want your retirement to be dependent on, is a stock market. So we'll talk about that, and actually we're going to talk today as we start this with a couple that really took a big loss in there, and I don't know how they did this over the last couple of years, but obviously they didn't have an advisor. Woman writes into the Yahoo Finance advisor column, and she says, our investments were at $450,000. Now they're at $250,000. How do you lose money in the last couple of years? I don't know. But it's interesting that she asks this question: how much do I lose before I go to cash? When it comes to losses, when is enough enough? Well, Jay, you've gone through this. You've gone through 2008. Yep. You've gone through 2000, and you've watched people. Where is it that people finally say, that's it? I'm going to cash. I'm not going to lose any more. And how can we avoid this situation altogether?
Yeah. My first question is yours. That's almost a 50% loss.
Yeah. How did this happen?
And you got to have a lot of talent to lose that much in these markets. Unless she was in Bitcoin or something, I don't know.
Right.
So, I mean, a lot of red flags in those few sentences, right? But, I would reframe the problem and the situation into a different lens. Okay. And it is about, I'm assuming, I don't know if you mentioned it or not, I'm assuming this lady's retired.
Yeah.
Or she's planning for retirement or something, right? First of all, you should never be invested in something that you could lose 50%. It sounds like it happened pretty quickly too.
Right.
With your investment, I don't think she would. I mean, nobody wants to lose that sort of money, but I don't think she would be as panicked about this if she had other irons in the fire, for want of a better word. Right. When you move from work life to retirement life, everything is changing. You're going from, a place you went to work for 40 plus hours a week, occupying a good chunk of your time. You went to a paycheck coming in, however you got paid, twice a month, every other week, whatever it is, accumulating funds in your retirement accounts, to now turning that whole thing on its head. And you got more time on your hands, which is great. It's probably what you wanted, right? You wanted to be able to have more time to do the things that you liked. But now also, instead of accumulating funds, you're going to be distributing those, and you've got to find a way to make that last the rest of your life. There are multiple things you need. This is why we talk about 401k money coming out of the 401k. And people ask us, should I move my money out of the 401k? And I say, I'm not going to tell you whether you should move your money out of the 401k. I'm just going to talk through a few different things about what your situation is inside the 401k and what your situation is outside of the 401k. And most 401ks, you've got a handful of investment options. You've got 7 or 8 target date funds, and then you've got another 8 or 9 other funds that you can invest in. Now, while you're growing your money, that's probably okay. Once you're moving into retirement, you want to do several things. Do I want a bit of growth? Yeah, I want a bit of growth. I can't stick my neck out there too far. I also need some income. There's all these other things going on that probably your 401k doesn't have enough options to achieve. You're also essentially your own advisor while your money's in the 401k. You're the one making the decision. And that's evident when we ask people, hey, how did you come to this allocation that you have in the 401k? And it's, I don't know. I talked to my coworker a few years ago and this seemed to be okay. So we just put it in that and I left it. I never changed it, right? So, getting your retirement set up so your income needs are taken care of and you have a bucket that's growth and you have a bucket that's conservative and having these things addressed helps to diminish some of the concern. Because she's saying, when do I go to cash? The next thing that's about to happen to this lady, I can tell you, is if she's already asking, when do I go to cash? She's almost there, right? She's probably going to make that decision pretty soon. And she's going to get into cash and then hopefully this is some sort of diversified portfolio she's in. I don't know how it could be if you're down 50%, but anyway, she's going to get into cash. And then the next question is, well, when do I get back in?
Yeah.
What do I do now? Is cash the long-term solution? It's not. Everybody knows it's not. People have been in cash for a bit now because interest rates are higher. And everybody who was in cash saying, I'm getting 5% in the money market, this is fantastic. I said, yeah, look, that's great right now. And I'm not saying you shouldn't take advantage of it. What are you going to do when that 5% becomes a 4? And it becomes a 3? And that's where we are now, right? It keeps going down and down, so it's not a long-term solution. And let me kind of tie this all together with a story that we had from someone who's not a client anymore, because after this event, we basically had the discussion that we're not the right fit for you because you won't let us help you, right? And, we had a client come on board, nice guy, an aggressive investor by his own standards. He says, I'm an aggressive investor. And I said, hey, if you insist on us investing you aggressively, we will do as you wish. It's not our recommendation. It's going to be notated very well that this is not our recommendation. I know you're used to doing this in retirement, being invested this way, but you're in a different stage of life now, right? You don't have the security of a paycheck coming in every couple of weeks. We've got to make the money happen with your IRA now. You don't have as much time as you used to back, when you were working, you might have had a 10, 20 year runway before your retirement. You're in retirement now. Things are different. No. I'm an aggressive investor. Okay. You're an aggressive investor. So we get set up and, this is probably in 23. So everything's going fine for a while. And then March of 2025 comes, all right? So, 12 months ago. And just to jog everyone's memory, you probably remember this, Randy.
Liberation Day.
That was when Trump, Liberation Day.
Yeah.
All right. That was when Trump came out with his tariffs. And, everything was kind of a little bit rattly there for a while. And then the market just fell off a cliff, right? And I can't remember the exact numbers, but it was something like we were down 15% in a matter of a week or something. It was tough, It was a 5% down day followed by another 5% down day. And this gentleman called us freaking out. And the first thing I said to him was like, do you remember when I said you're not really an aggressive investor, right? This is why we had this conversation. And so he says, well, I want to get half of my money out of the markets. And this was, a couple of days in. And, we try and talk him through it that, we're in this portfolio right now. It's probably not a good idea to exit it while this is going on. Let's give it some time. No. I've got to get half of it out. All right. Hey, ultimately, he's the boss, right? It's his money. So we got to do what he says. So we go ahead and do it. Another day or two goes by. The market's still just going down. And he calls in and I talk to him personally. And he wants to get everything out of the markets. Now, I might be getting a day or two off with this, right? Because it is a year ago. This was on either a Monday or a Tuesday. I can't remember what day it was. Monday or Tuesday. I think it was a Monday. And I'm talking to him. I talked to him for probably an hour, trying to just kind of like rationalize things, talk him off the ledge, and ultimately he said, no, like I want everything out of the markets. So now we got it's his money. We got to do it.
Yeah.
So now he's 100% out of the markets. All right. The next day was the day that Trump came out and put a 90-day pause on the tariffs, and the NASDAQ was up 12% in one day.
And he missed that run up.
He missed it, and he called in and we were talking, and he's like, no, I'm not going to get back in because this is just a bounce. Like, it's going to crash again. And at this point, we're kind of like, all right, dude, whatever you want to do, right? It's the damage is done, right? Anyway, so, a bit of time goes by and we have the hard discussion of, you probably need to find somebody else, right? Because this is, you're sabotaging yourself. I don't know what happened with his situation, but the market has been pretty much, there's been some bumps here and there. It's been pretty much straight up since then. So not only did he miss the recovery, he's probably missed another 20% on top of that. And so he's stuck in, I don't know, like I said, I don't know if he got back in or not, but this is the issue this lady is going to then run into, is now I'm out of the markets. Okay, the bleeding has stopped. Now what do I do with it now? And this is all due to not having a comprehensive plan in place.
It's an interesting question. I mean, any financial advisor is going to look at you as a new client, and they're going to try to get a bead on your appetite for risk. And they're going to ask you a question like, how much are you comfortable losing? And you look at them and go, really? That's what you're asking me? It's like a baseball player looks at his coach, and he's a brand new player. He says, how much are you comfortable with me striking out? And it's like, I mean, seriously. So here's my thing about that. If you don't know what to talk about with a financial advisor and you don't know what to ask, once you get figured out how much you need per month, look right at them and say, I need $7,500 per month. Don't ever put that in jeopardy. And see what they say, because that's going to be your risk profile right there. Is this has to come in every month, whatever's happening out there in the market, whatever. I need this per month to survive. This is what I need. And that's probably going to be a real good opener for the conversation.
Yeah, that's a great way to start the conversation. And think of this as well, right? And we're just kind of throwing numbers against the wall here because everyone's situation is a bit different. But if you go into, come and visit us, see your advisor, whatever it is, and you have that conversation you just had with them, Randy, and you said, I need X amount of dollars monthly. I need 5,000, I need 7, whatever it is. I don't want to have to worry about that coming in. I don't want a situation where Trump decides to do something and the market goes down 15% in a couple of days. I don't want to have to worry about it. I don't want to have to worry about an Iran-US conflict or whatever other geopolitical event is going to come up, right? I don't have to worry about that. And let's say out of your $1 million, it costs half of your portfolio to do that. It costs $500,000, right? And as I said, we're throwing numbers against the wall here. Look at the freedom that's given you.
Yeah.
The rest of your life is guaranteed on your income. And the second part to that is that $500,000 that you have left, you can get super aggressive with it. You can invest it very aggressively. They say that, the more aggressive you are, the higher the return in the long run. In general, historically, that's true. Unfortunately, it's not a line at a 45-degree angle. It's this jagged chart that goes all over the place and then eventually over time ends up higher. But getting the planning done, like simply we just talked about, it allows you security, freedom, and growth potential in your remaining money.
You're listening to Clear Skies Retirement with Jay Kirkwood at Secure Financial Management. Online, it's retire210.com. Go to the website today, tool around a little bit, learn more about Jay and the team. And down at the bottom of the page is a place for you to put some information in there. You'll see Jay's book, which is called Wall Street's Game. If you make an appointment, get a date on a calendar, come on in, we'll give you a copy of that book. If you want to get a little taste of it, you can download a chapter from that book just by going to the website. So give you kind of a little look at what Jay is all about. The important thing is getting a date on a calendar to talk about your retirement. Get your eyes open, know what you're up against as you go into your retirement years. Let's get something down on paper. Right. Retire210.com or 210-985-6200. Well, this is one of my favorite times of the year. Is it because it's spring? No, not really. This time of year is one of my favorite times because I like ice cream. I like mint ice cream. And at McDonald's, this is the time of year for the Shamrock Shake. Yes. Jay, have you ever had a Shamrock Shake?
Yeah, I was just about to tell you, for probably 15 years, I've been wanting to try one of those, and I always miss the window because it seems like it's only 2 or 3 weeks.
It is. It's just like about a month. It's around St. Patrick's Day, and
then if I do go, the darn machines are always broken. I don't know what the deal is with that.
I do. Okay, I'm going to give you the story behind that real fast. Okay, so there's actually a website out there. It's called McBroken, and McBroken.com, and they show you all of the McDonald's where the machines are supposedly broken. I found out the story behind that is McDonald's used a company called Taylor for their ice cream machines, and their contract said that only Taylor service people can work on Taylor machines. So if it broke down, they were stuck until that particular person came.
Oh, man.
And it took some time sometimes. I think it is, like if you go at 9 or 10 o'clock at night, I think that Skippy in the back room already cleaned the whole thing out and doesn't want
They don't want to clean it again.
They don't want to clean it again. So
Probably.
He just tells you it's broken. That's what I think anyway.
There you go. That's the easy answer.
You're exactly right. The window of opportunity for a Shamrock Shake is about a month. If you don't get it, you lose it. So here's my big financial spin on that one. There are things in retirement as well that have a window of opportunity. I think of, there's no sense in trying to file for Social Security after 70 because that's the most you're going to get. There's tax loss harvesting has to be done by December 31st. But the one that we talk about a lot, Jay, is the idea of taking money from your 401k and moving it over to a Roth, the conversion idea. There's a lot of people who have different ideas about what that window of opportunity is. Some people will say it's got to be done by 60 or 59 and a half. Other people will say we'll do it up to RMD age. Other people will say we can keep doing it after RMD age. That's a long runway. What is your experience there? Do people do it after RMDs and things like that? What's your experience there?
Yeah, we try and get ahead of that RMD conversion opportunity or I shouldn't say RMD conversion opportunity. I guess you could think of it as taking a voluntary RMD, right? And converting that into a Roth. We try and get ahead of that as soon as possible. Just yesterday, we had some clients in, a couple, and there's a little bit of an age difference between them. I think it's like 8 years or something like that. He's 65 and she's 57 or whatever it is. And we were talking about this, and I said, hey, we've got to get started with his. Let's get these Roth conversions started for his as soon as possible. And she was a little bit upset. She said, well, why are you just focusing on his? Like, what about mine? I was like, hey, you've got a longer runway. So she liked that part, right? You're so much younger. We've got more time for you, right?
Okay.
But that's what it is, right? And the reason is, and this is where... this is good we're talking about this because it's becoming a more and more common thing that is tripping people up. And it's what is your ability to do Roth conversions? Now, the truth is, you can do Roth conversions whenever you like. Now, there are going to be more advantageous times, and let's talk about why that is. I've talked to you a couple of times on the show about, I have a couple that kind of visited us for years, didn't become clients, became clients when they had RMD issues, and I'll just kind of fast forward through all that. So anyway, we'll pick it up to where I think it was like a $300,000 RMD between the two of them that they had to take. Huge. And they said, well, this isn't ideal. We weren't expecting this. We didn't plan for it, but at least, we got to pay the taxes, and then we'll just do this into a Roth. We'll do a Roth conversion with this. And I said, I hate to say this, but we may as well get all the bad news out of at the moment, right? You can't do a Roth conversion with required RMD money.
Okay.
So and they said, so we can't do a Roth conversion. I said, no, you can do a Roth conversion, but this is a couple that. They were making like $120,000 a year just from their pensions and their Social Security, right? So now they're putting $300,000 on top of that from their required distribution. So the IRS is looking at these guys saying, this is awesome. These guys made $520,000 a year as far as we're concerned, and we're going to tax them at that rate. Wow. So if we want to do Roth conversions now that you're in RMD age, we've got to take more money and stack it on top of that 520.
Right.
So I know when we get people into the office that have listened to us for a while, sometimes, a year or longer, and they say that, man, you guys spend a lot of time talking about, getting an income plan for retirement and getting ahead of your RMDs and doing your Roth conversions. I say, yeah, this is the perfect example of why, is because all of those tax benefits you thought you were setting up while you were working, deferring your income. Hey, we'll make contributions to our 401k. We'll get that out of our paycheck, and then we'll take it in retirement. All of that is getting undone for a lot of people because they're burning the most important opportunities of their life from when they retire to when they're required to take distributions. Yeah.
So there is that window of opportunity there. Would you say to people that if they are on a runway where they're still working and they're working with you, maybe say let's put them at 62, they're going to retire at 65, and then the income goes down about 66. Would you do small conversions up until they retired and then ramp up the conversions? Or would you wait until after they retire and then their income is down and that's where we really go after it?
Yeah, so case by case, obviously, but at a high level, usually while people are working, you wouldn't be doing Roth conversions. Okay? Because like the people that we deal with, they're getting close to retirement if they're not already retired. Usually, you're in your highest earning years before you retire. That's usually, for most people, what it is. What we do say, though, is we say, hey, we'll start looking at the 401k or wherever the money is, and we'll say, let's do this, though. Let's stop compounding the problem, okay? Let's not keep doing tax-deferred contributions to your 401k. Let's start doing Roth contributions.
Okay.
Right? So that is starting to help us in the form of, no, we're not doing Roth conversions. We're just doing straight up Roth contributions. So what that's helping us do is that when it comes time for us to manage this tax issue, we've got a smaller bucket that we have to manage, right? And so that is a planning tool that can be used by some. Most 401ks now do have Roth contribution options available.
So when somebody gets into retirement and they have a large 401k, would that be the first bucket that they start drawing from so they can whittle that down a little bit so that by the time they get to 73 or 75, that it's not as big a problem?
Yeah, maybe. But this is the other problem people are dealing with now too, is if you're under 65, very few companies now, or less and less, I should say, companies now offer retiree health insurance.
Okay.
Right? And so now, if you retire before you're 65, your option really only is Affordable Care Act stuff. And the Affordable Care Act, it's not really affordable if you're not getting a subsidy to help pay for it, right? So they call it the Affordable Care Act, but unless you're getting the subsidy, it's not really affordable, right?
Right.
So now it's also about managing, well, how much income do I recognize here to try and keep that low so I can get some sort of subsidy to help pay for my health. When you and I talk about that there is a lot going on in retirement to manage, we're not kidding.
Yep. It's a balancing act.
There's a lot going on.
It's a juggling. It's like balls in the air. It's nuts. Well, if you want help with that juggling act, Jay is here for you, and so is the team at Secure Financial Management. Give Jay a call. Give him a look on the website. Here's the website, retire210.com. And when you go there, you'll see down at the bottom of the page a place for you to put a little information in there, and the team will reach out to you, or you can reach out to us right now. It's 210-985-6200. 210-985-6200. A no-cost, no-obligation look at your retirement. Check out the website today, retire210.com. And remember to have this podcast delivered straight to your favorite podcast platform by hitting like, follow, or the subscribe button. Thanks again for listening to Clear Skies Retirement, and we'll see you next time.
Investment advisory services offered through investment advisory representatives at Secure Financial Management, a registered investment advisor. Exposure to ideas and financial vehicles discussed are not designed nor intended to be applicable to any person's individual circumstances. It should not be considered as investment advice, nor does it constitute a recommendation that anyone engage in or refrain from a particular course of action. Past performance is not a guarantee of future results. Investments can fluctuate, and when redeemed may be worth more or less than when originally invested. Financial professionals are not licensed in all 50 states. To find out if Secure Financial Management is licensed in your state, please contact their office. Secure Financial Management is not affiliated with nor endorsed by the Social Security Administration or any other government agency. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through Wholesalers Insurance. Jay Kirkwood, Texas Insurance License number 1421850.